start discussing and decoding some of the earnings candidates. Suprajit Engineering, to begin with, that stock is up about 3%. Good set of numbers. The margin expansion has been rather healthy. So let's interact with the management. We have Mr. Ajith Kumar Rai, the founder and chairman of Suprajit Engineering, joining us on the show. Mr. Rai, hi, morning, and thank you for your time and your financials. Let's talk about that. It's been a strong quarter for you. Start by telling us about your EBITDA margins. I was just taking a look at your numbers, and they've expanded sharply to now in double digits at 10.6% from 7.4% this time last year. Help us understand what has driven this improvement and what is the outlook on EBITDA margins. Would you guide to continue to be in this double-digit range?
Good morning, and thank you for having me on your channel. Yes, we had a very good quarter and the first half of the year. The numbers have been largely driven by a wonderful restructuring efforts that we have done at our subsidiaries overseas and the outcome of the same. The controls division has done exceptionally well. It has improved its margin significantly from what it was last year, thanks to all this restructuring and operational efficiency. So overall, you are right. Our EBITDA margins have significantly improved from a single digit to about 11% on a consolidated basis, which is ahead of our own internal estimates, thanks to the wonderful work of the team. So is it going to continue? Yes, I think the restructuring at subsidiaries are continuing. They're at a very good pace, and I think they will all complete by December of this year. So once it is completed, I think the traction will be even better. So the controls division itself in the last 2 quarters have done a consistent 11.5% EBITDA margin, which I think is, from a global perspective, they're all international businesses, which typically operate at 5-6%. We are at about 11.5%. So our guidance is that our second half would be better than the first half, not just in the controls division, but across all our divisions. So we actually expect a much better second half compared to the first half.
Mr. Rai, just clarify this for us. Much better second half than first half, both in terms of growth and margins?
Yes.
And this is despite everything that's happening around tariffs. I mean, of course, there's a resolution which is likely to come through. But even if that were not to come through?
Yeah, I think tariff and also these things like the rare earth issues from China and other geopolitical issues continue to be big challenges for us in the global business. But the kind of mitigation plans that we have put in place and the ability for us to respond to customers, ever-changing requirements makes us uniquely positioned to deal with these problems. So I think we are best positioned, at least in our business, what we do. And despite these tariff issues, I mean, we have passed on most of the tariffs to customers. We have been able to convince them. And we're also giving them mitigating plans. So to us, yes, there are challenges, but yes, second half will be better than the first half.
Sir, tell us, if some of these challenges were to go away, is there a meaningful or significant upside to H2 or FY27 guidance? Is that at all the path or the journey that one can see Suprajit take?
I think that's a little bit of a wishful thinking. The kind of global uncertainties will not go away that fast. So we are fairly sanguine and a little bit, conservative in all these things. But let's assume the tariff issues are resolved. It's not going to change the volumes of business in US or Europe. I think they'll continue to be subdued for some time. So the plan or what we are doing is that we are going ahead and implementing some of these internal changes, which will help us to improve our margins. So the second half margins should be better than the first half, but that is not going to change significantly if, let us assume, India and the US strikes a deal. But I think the volumes will not really change.
And Mr. Rai, I'm taking a look at the commentary after the earnings, and while most of your segments you've guided that the second half will be better, you've said the same for Phoenix Lamps divisions as well, but you have also said that headwinds that were seen earlier may continue. Could you elaborate for our viewers what these headwinds could be, and more importantly, by when do you see these headwinds behind you?
No, the headwinds at Phoenix Lamps division is basically been one of, ability to push more of our branded business in the global market, particularly in the Middle East. And also to some extent there, I think aftermarkets have been slightly weak because, as you know, Phoenix Lamps is mostly an aftermarket business. Having said that, I think some of them are behind us. I think we are seeing a much better second half. But as far as the other divisions are concerned, I think we are pretty strong and we are very confident than the second half numbers, whether it's the domestic cable division or electronics division or our controls division, are continuing to get good traction in terms of not in terms of volumes of existing business, but quite a bit of new contracts that is getting into production. For example, in domestic cable division, the beyond cables project, the braking products, the other CBS products are all getting traction. Electronics division having a great traction in our electronic grips and also digital clusters. And obviously on the controls division, we are seeing significant new contracts getting into production, although some of them have been delayed, but they have not been shelved. So overall, I think we are in a much more confident position today than probably what we were 3 or 4 months back.
And Mr. Rai, sorry, last question from my side. When I'm looking at the financials, the inventory as well as the receivable inch up that's happened over H1 FY26, I believe some of that may unwind. Is that normal course of business? Can you just give us a sense as to why that is so, and is that something we can expect going forward as well?
No, the increases in some of the inventories are largely because of our recent acquisition of SCS entities, because suddenly that has come and sat on our existing inventory, which wasn't there last year. So I think that's basically the reason. Inventory unwinding, I don't think, we are in automotive business. We don't really produce to stock. We produce to sell. So typically it is sold eventually. There will be some amount of stock building would have happened in this half year only because our ORS facility has been shut down and the entire business has been relocated to Matamoros. To that extent, there might have been some excess inventory that has been built up, but they're all, normal business environment operationally done. But I don't think that will change the margin profile at all going forward.
Okay, so that's the take coming in. And lastly, before we let you go, Mr. Rai, if you could give us any update on that SCS acquisition and if you're still confident about it being margin accretive by the fourth quarter itself?
Yes. SCS entities, we have taken from an insolvent situation. So obviously, it has been incurring losses all these days. We have also given quarterly numbers of how it has changed. If you see the latest quarter from something like a minus 30% EBITDA, it's at about 6% minus EBITDA now. And we have very clearly guided that kind of restructuring that has happened at multiple levels, at Germany, at Morocco, at China, as well as in Canada. They're all progressing very well, and we are very confident that by fourth quarter, it will be EBITDA positive. And I think it would add to the overall strength of Suprajit in terms of its, excellent global player in our controls cable business to give the best solution to our customers. So we are expecting the turnaround as we have planned.
Thank you so much, Mr. Rai, for coming in and speaking with us. And
thank you.